My real estate AI just made Excel shit itself. Watch this. Watch how we're going to stress test this 18-unit portfolio refi. We're instantly going to see how much cash we have to bring to close across all of them. But I've also built in predictive analysis, so it's going to look at historical data in the area, current data, and it's going to predict forward in the future what might take place, factoring in inflation and risk assessments, best and worst case scenarios. It's going to run all the numbers for me on a refi, a sale, or a hybrid, right? Because if things go bad, selling some, holding some, so we actually never go negative. In addition to telling me my internal rate of return, cash on cash, and ROI in every scenario instantly. What it does is tell me all the appreciation data right now, right across the area, but it's also going to project forward with all the numbers I have on the Excel sheet that I attached. Look, I said, what's my cash to close total for the refi and safely? What will be my cash flow per year across all properties per month/year? Told me my cash to close because it's a little bit over the 75 LTV on some of the properties. Broke down my projected cash flow, right? Year 7 I wanted to see. It's going to reflect rent increases, inflation, and all model expenses, including 7% interest only, right? 8% management taxes and insurance. Let me know if you'd like the same breakdown for years 4 through 5. Yes, I said yes, cash flows year 1 through 5. And look at that. Here's your total portfolio cash flows for each of the first 5 years, plus all properties combined. Tells me per year, annual, and monthly. There we go. These numbers include rent escalations, inflation on taxes, insurance, management fees, and debt service at the 7%, right, we were talking about. Let me know if you'd like to see the same forecast extended through year 7 or under refinance scenario after year 5. Yeah, so what's my cash on cash on, or internal rate of return, having to put that money down at close? How long would it take me to recoup that? Breaks it down in a chart, but also below. Look at this. It's a clean summary of your cash on cash, internal rate of return, and capital payback timing based on your money down. Cash on cash annual. Look at this. Payback period, it breaks all that down for me. Internal rate of return in 7 years, right? I just asked, so should I sell in year 5 through 7 or just refi again? What's my profits if I sell? Then it's going to tell me all of that. Sale versus refinance, year 7, right? All the total proceeds. Total cash flow from year 1 through 7, initial equity invested, cash to close. Total profits if you sell in year 7. Should I sell or refinance? Option 1. My options and why I should consider each one if I want to do a 1031. Option 2, refi again, is going to tell me what I could probably get out. Gives me a strategy suggestion, right? Then it tells me if I want to get into larger stuff, what I could do plus my 1031. You want me to model that? I could say yes. I said, yes, model that please. And it does it for me just about instantly. Tell me pretty much my equity pulled on that refi again, new portfolio cash flow post refi years 8 through 10, total value from refi strategy, hold 3 or more years, is going to tell me all that. Then broke down that comparison, refinance versus sale at year 7, right? Your sale price is immediate profit, 3-year cash flow, taxes due, flexibility, clean exit or 1031, right? And if you refi and hold, again, what that's going to look like. This gets really good. Recommendation, if your goal is liquidity, and it tells you recommendations. But I said, what's worst case things that can happen? Let's factor in vacancy rates and medium to high repairs that I might have to do. Any other worst case scenario we should consider? Great question. Stress testing your portfolio is a smart move before committing capital. Here's your full worst case scenario analyst to help you gauge risk, exposure, cash buffer needs, and long-term viability. Then what it's going to do, rerun everything for vacancy risk higher, assume 10% across the entire portfolio, right? In a rough year, that reduces your gross rent by 60 to K90 annually. Maintenance and capex risk, right? It tells me all those risks. Older properties, etc. Medium, high with 10 units, expect 30 to 100 a year in potential. Deferred repairs, HVAC, roofs, plumbing, etc. Property taxes, insurance shock. Factor in, right, reassessments. Insurance, especially in the Southeast, is rising 10 to 20% annually in some cases. Factor in 20% increase in both over normal inflation equals additional 10 to 15 year drag. What if you get stuck with higher rates? Refi risk, right? 8 versus the 7. Cash flow may drop by this much per year. High rates reduce equity you can extract on future refis. Regulatory risk, rent caps. What it does is portfolio level worst case stress scenarios. Let's model 12% portfolio wide vacancy, 50K unexpected capex across properties, 20% increase in taxes and insurance. Refi rates jump to 8. It's going to rerun everything for me and model all those changes and what that looks like. In this worst case scenario, you're still profitable, but much leaner. Then it tells me all my risk mitigation strategies, what those look like, right? And if you want to underwrite any differently. Final thought, Tells me a final thought. Your net income could drop by 50% or more, but here's what we're going to do now. Yes, run a formal stress case versus best case side by side. Check this out. Here's a full side-by-side comparison, right? Best and worst case metric, like your best case, your stress case. Look at all the numbers, how different they are. And read this, why it drops so hard. Look at this. Tells me all my takeaways, but this is where it gets fun. Let's model a hybrid blended strategy so we never go negative, assuming worst case situations, we hold some and we sell some, Hybrid, stress, hold half, sell half, so you never go negative. Check this out, all the numbers again. Why this works, selling the highest equity half covers any drag from vacancy or capex on the hold side. Even under worst case assumptions, you're still highly profitable and never go negative or have it to come out of pocket at all. You retain ownership of half the portfolio and maintain future appreciation and depreciation write-offs. Then it says, this is a very capital safe and flexible strategy. Allows you to reinvest 1.7 or roll into 1031s, retains long-term upside with lower loan exposure, absorbs capex vacancy risk without eroding equity. Would you like to see this converted into a hold sell asset list or mapped to a 1031? If I want to do that, I just hit yes. So are you a real estate investor? Do you want to run those risk assessments, stress test your portfolio or your next project based on historical data, current data, and a peek into the future, right? Building in and factoring in for those what-if situations. Reach out to me today, comment show me on this video, we'll set up a demo, and I'll tell you how to make smarter decisions, review more deals, but working less time, guys. This is total game changer. Look forward to talking.